What advice do you give for the average person that's looking to invest their salary or their wages?
Don't own US stocks. That's a simple strategy that you can act on.
What about S&P 500?
No. Really? Yeah. And if you have a big position in US technology stock, my personal advice would be to sell it all.
But I'm an investor in SpaceX.
Good luck. SpaceX is such a fabulous BS story, and we can go into that.
Crypto?
No.
Why?
It's an unnecessary piece of nonsense that facilitates nothing except criminals moving money, but they can't be seen.
Do you think Bitcoin's going to go to zero?
Yes, it will certainly go to zero.
So how many years have you spent investing?
60 years.
And what's the most amount of money you've ever managed of other people's money?
165 billion.
And one of the things you're famous for talking about is this idea of bubbles.
Yes, and bubbles always occur around the very most important ideas. So the railroads, everyone could see that it would change the world. The same with the internet. And everyone wanted to put their money in, and so they overinvested. But this is the problem. Eventually, they bust. And if you look at the great bubbles breaking of the past, you find that it's followed by really tough times, a miserable period for the economy. And the bigger the bubble, the bigger the bust. And now we're in the biggest investment bubble that arguably has ever occurred, AI.
Are we on the verge of a collapse with AI over the coming years?
The next few days, the next few weeks, the next few months, but certainly the next few years.
So if you're not someone that has a huge amount of savings, what kind of strategy should they be adopting when an economy starts to get bad and there's an economic bubble collapse?
So I will go through everything, but you will not receive this advice from investment advisors because they'll lose a lot of business.
And would you be thinking about the country you live in at this moment in time?
Absolutely.
Is there any countries you wouldn't live in?
I think I have to refuse to answer this on the grounds that it might tend to incriminate me.
Oh, okay. So you're saying don't live in the United States? I've just moved here. Why not the United States? This is super interesting to me. My team give me this report to show me how many of you that watch this show subscribe, and some of you have told us, according to this, that you are unsubscribed from the channel randomly. So, favour to ask all of you, please could you check right now if you've hit the subscribe button, if you are a regular viewer of the show and you like what we do here. We're approaching quite a significant landmark on this show in terms of a subscriber number. So if there was one simple free thing that you could do to help us, my team, everyone here, to keep this show free, to keep it improving year over year and week over week, it is just to hit that subscribe button and to double check if you've hit it. Only thing I'll ever ask of you, do we have a deal? If you do it, I'll tell you what I'll do. I'll make sure every single week, every single month, we fight harder and harder and harder and harder to bring you the guests and conversations that you want to hear. I've stayed true to that promise since the very beginning of the Diary of a CEO, and I will not let you down. Please help us, really appreciate it. Let's get on with the show. Jeremy Grantham, your firm managed up to $165 billion at its peak, what we call AUM, assets under management. So you know a lot about money, you know a lot about investing. How do you sort of self-define your expertise? Because you traverse so many different subjects through your work. So if I said to you, how do you introduce yourself professionally? What is the answer?
I can't think I ever do introduce myself professionally, but I think of myself as specializing in a longer term horizon than most people, and trying to look at a higher and higher level of abstraction. What is really going on here? And what are people missing? I've discovered over decades that humans are incredibly short-term oriented, and they have an enormous predisposition to optimism. They're looking for optimistic news in everything. They're looking to avoid unpleasantness. The idea that you can have steady compound growth is ridiculous. One of my few heroes, Kenneth Boulding, an economist, he said the only people who think you can have compound growth on a finite planet are madmen and economists, which is so accurate. Economists simply believe you can have growth always, and everything comes down to just price.
One of the things you're famous for talking about is this idea of bubbles. And we're living in a moment where everybody's talking about the subject of artificial intelligence, and everyone's getting very excited by it. Some people are getting very pessimistic about the impact it'll have on society. I wanted to start there because it's an area where there is rife optimism on one side of things, but there's also a lot of money plowing into the market, which is, I guess in your view, making things prone to collapse. What's your view on artificial intelligence? Well, you said you're good at understanding what people are missing. What is it that people are missing?
Well, first of all, let me say, I think artificial intelligence is right up there with the railroads. It's one of the defining great ideas of the last couple of hundred years. It's going to change everything, and that is critical. If you mean to have a bubble, People think that a bubble is mainly because it's a scam, and nothing could be further from the truth. The great bubbles always occur around the very most important ideas. So the railroads, everyone could see that it would change the world. And everyone wanted to put their money in. And everybody put their money in. They overinvested. And even though the railroads were a spectacularly powerful idea, the railroads collapsed as stocks and everybody lost a ton of dough. The same with the internet. And then out of the wreckage, the railroads changed the world and the internet changed the world. What we have to remember is that in '99, Amazon went up 6 or 7 times. In the crash, in the tech bubble, it went down 92%. As I like to say, check it. It's such a remarkably large number. And then out of the wreckage, it inherited the retail world. And that's how it works. The greater the idea, the more obvious the idea, the more money goes in, and the bigger the bubble, and the bigger the bust.
And are we on the verge of a collapse with AI? When I say verge, I mean over the coming years.
If you look at the data, it would be compatible with history for the peak to be very soon. Everything is in line. This is, I think, the biggest investment bubble in American history. The indicators of a pure, crazy euphoria, like SpaceX, are all over the place. SpaceX defines as its addressable market a quarter of the global GDP. It talks about endless opportunities mining asteroids. It will be in 50 years, in 100 years, people will look back and tell stories about SpaceX and its prospectus, like they tell stories about the South Sea bubble. An enterprise of such enormous value, but it cannot at this time be revealed.
I want to keep on this train, but for the viewers that don't know your experience, we should probably pause and just tell them your experience, because that's the reference point, but also gives you credibility and authority to speak to this. What have you done with your life?
Well, I got into the investment business in 1968. There were very few serious people in the investment business. There were no mathematical models. There were the kind of relatively failed sons of rich people who would work for JP Morgan. And then over the next 10 years, it began to get a little more serious. T. Rowe Price introduced the idea of growth stocks. A few of us introduced the idea of value stocks. And a few years later, at my first firm, Battery March, we really introduced the idea of small cap. It hadn't existed before that.
And for people that don't know, a small cap is investing in smaller companies.
Yes, and a value stock is simply one that looks cheap.
Did you invent the index fund?
There were 2 or 3 of us separately. I don't think we knew of each other.
How many years have you spent investing?
60 approximately.
60. And what's the most amount of money you've ever managed for other people in a calendar year?
Yes, 165 billion. I had 2 partners, Mayo and Van Otterlo. And when the smoke cleared, I've made a lot of money, over $1 billion.
Personally?
Personally.
And how much?
And paid tax on all of it.
Oh, good. And how much money does your firm still manage today of other people's money?
It manages 85 billion.
85 billion. So are you a billionaire?
I'm generally referred to as a billionaire, but that's only because they count the money you give away, because I've given over 90% of my billion away to a foundation.
Oh, really?
Yeah.
To which foundation?
It's called the Grantham Foundation for the Protection of the Environment. We invest a lot of our principal in green tech to help combat climate change.
And you're 87 years old?
And I'm 87 years old.
You've given 90% of your money away to your own foundation that's focused on green tech?
Yeah, maybe 95. Yeah.
Wow. Okay. So coming back to this point that we were talking about, a lot of people won't even know what a bubble is. I think you've done a good job of explaining. A bubble is when everyone gets excited, they all see something obvious,
Yes.
They plow their money in, the stocks go up, and then if you look at the graph that's in front of you there, which shows the history of asset bubbles, eventually there's a big collapse.
Yeah.
And you're saying that the collapse is on the horizon.
Yes.
And what does that mean for the average person? What's going to happen?
What's going to happen is the high flyers will probably come down a lot.
The high flyers?
The stocks that have gone up the most, AI and the more exciting stocks for the biggest moves. Historically, would be expected to come down the most. From these unprecedented levels, a 70% decline would not be unexpected.
So a 70% decline in the stock price?
Yeah. And you have to remember the tech bubble, the NASDAQ, which is an index of the growth stocks, came down 82%. It is far from unprecedented to have these major declines. And the biggest bubble in history was in the Japanese stock market in 1989. Back then, Japan seemed to rule the world, all the technology, all the Toyotas were kicking bottoms in General Motors and so on. And everyone bragged about their 12-inch Sony TV in the kitchen and the quality, et cetera, little things you put on your belt to play music. They were all Japanese. Mm-hmm. And for a second, Japan sold for more than the US in '89. And it got to 65 times earnings, which means for every dollar of earnings, you have $65 of market value. And the US went to 35 in the tech bubble of 2000. You could argue, depending on how you do it, that it's 35 or 40 today, but it's not 65. So we have seen a much bigger bubble in Japan. And what happened? It went up and up and up, and then it came down for 20 years.
20 years?
20 years. They talk about the lost decade, but when you look at it closely, it looks more like a lost 20 years.
So for the average person, what do they feel and how does it impact them when there's a market crash like the one that you're forecasting?
The high flyers will lay people off, and a lot of people will feel less rich. And as you acquire money in the stock market, a small fraction of that, 2 or 3%, is spent. And in reverse, it goes back. And people feel a little bit poorer, they spend a little less. So the economy tends to be under some stress. And if you look at the great bubbles breaking of the past, you find that it's followed by really tough times. 1929 is followed by the Great Depression that lasts for several years. And of course, there are many other factors that go into that. But it started with the crash in the market, which was, in the end, down about 80% or more. And then the next one was called the Nifty 50 because it was the 50 great companies like IBM and Coca-Cola. And that was in 1972, it peaked. It declined by 65% if you adjust for inflation. The recession associated with that was just about the worst since the Depression.
So for the average person, what kind of strategy should they be adopting if you're not someone that has a huge amount of savings? Say you're working for one of these big companies. Are there any strategies that you should be thinking about now before the markets come down and there could be a recession?
I mean, rule number one is always be diversified.
What does be diversified mean?
It means wholesome bonds, wholesome cash, perhaps a small amount of precious metals.
Like gold and silver?
Yeah.
And what is a bond? And how do I buy one?
Yeah, a bond is a loan that carries a fixed interest rate. Let's say today, 5%. You invest your money in it and it will pay you 5% as long as the credit worthiness of the other side is there. So if it's the US government, you'll assume it's pretty credit worthy. And you buy a bond from the US government. It's how the US government funds a part of its activities. You can buy a 30-year US government bond, a 10-year bond, a 2-year bond, a 90-day treasury bill, they call them, and they get that short. Everything goes fine. You receive this modest amount of money. You're 5% or you're 3%, depending on the conditions.
Okay, so a bond is basically lending the government money?
Yes.
And if you want to lend the government money...
Or lending a corporation money.
Okay, so you can also lend, like, Apple money?
Yes.
And I can go to the government website, or it says, I was just reading here, it says if you want to lend money directly to the US government, you can bypass Wall Street entirely, go to treasurydirect.gov, you open an account, link your bank, and purchase directly. You can buy treasury, bills, notes, bonds, and Series 1 savings bonds. You pay exactly face value with no commissions or fees, and the investment is backed by the full faith of the US government. Or you can buy, like Apple, you can lend Apple money. I didn't even know you could do this. and you go to any of your major brokers like Fidelity or Vanguard, or probably a lot of the apps. You navigate to fixed income section on your account, and you can see what bonds are being offered, and you can lend them money.
What you're doing, actually, they have distributed it to the market, and you're acquiring it from one of the existing owners.
Oh, okay.
You're not actually giving them incremental money. They come to the market with $10 billion in a particular bond with a particular coupon. It says, we will pay you 3.5%. That's the coupon. And when you want to buy some of that bond, you go to your broker and he says, it's no longer selling at the original 100. It's now selling at 92 or 107, and you pay that and it transfers from one owner to you. There have been times in 1974 when you could get a bond that would pay 8, 9, 10%.
Per year?
Yes, per year.
So if I buy a US government 10-year treasury bond, essentially lending the US government money, I can do 4.46% a year, and Apple's current yield on a 10-year corporate bond is 4.7% a year, so almost 5% a year, which means if I put, $1,000 in, I'll make $475 over 10 years. Interesting. I never really knew how bonds work. So you're saying market's collapsing, diversify, get some money into bonds, keep some money in cash, and anything else in terms of diversified portfolio? Property?
Property is fine, except it's pretty darn expensive by historical standards. They've engineered a situation where house prices tend to rise. Great for the people who have a house, and terrible for the people who would like to buy a house. Back in '94 in England, a typical house sold for 3.4 times your family income. That was about as low as it had been for 50 years. And then from '94 until today, it rose from 3.4 times to over 10 times, depending on where you live. And at 10 times income, a reasonable young couple are in big trouble. They can't really afford to buy a house. And that same high prices are reflected in rents. So they're really squeezed on living costs. And the same is true, even worse, in China and Canada, Australia, most of Europe. House prices have simply been allowed to go up for the last 30. They didn't, traditionally, they traded flat or down 60, 70, 80 years until 1994 in the UK. But since then, house prices have risen everywhere.
So are you expecting house prices to come down sharply? I think I heard you say that they might come down 30%.
Even if they come down 30%, they're really still very expensive, aren't they? That would be, they'd come down to 6 or 7 times family income. They'd still be twice what they used to be in the good old days.
So I've got diversify, I've got reduce your position. There is probably going to be a bit of a job disruption as well.
And particularly if you have to own stocks, own them outside America. Don't own US stocks. That's a nice, simple strategy that you can act on.
Why?
They're much cheaper. And since the beginning of last year, they have handsomely outperformed the US.
Foreign stocks?
Foreign stocks of emerging countries, of European countries, Japan, Canada, Australia, and so on. You can find good broad indices, kind of the world ex-US,
okay.
Or emerging markets. And
invest outside of America.
Yeah, I'm sure they'll muddle through okay over the next 10 or 20 years. And I am not confident that the US will do that.
You're not confident in which part? That the US
I'm not confident that US equities will be intact in 5 years, 10 years.
So a US equity is a US stock?
Yes.
Why aren't you confident that they'll be intact in 5 or 10 years?
Because they're so badly overpriced today. Back in the tech bubble of 2000, we had a 10-year forecast for US equities of -2% a year for 10 years. And they came out with -3%. The period from 2000 to 2010, you simply lost money in the US market. 10 years later, you had less money than you started with. And this is a higher price market, I believe, than 2000.
So you think it's going to be even worse?
In Japan, you went 20 years and you lost money. You went 30 years and you still hadn't gotten back. It took 35 years for the Japanese market to recover.
So what are you saying?
What I'm saying is it's quite typical to get beaten around the head in the stock market when it becomes crazily overpriced, as it is today, and that it's a very good idea to take some responsibility and watch your tail. Now, let me just say, you will not receive the advice from investment advisors to get your tail out of the market, ever. It is not good business for them to do that, and they will not ever say it to you. So from 1929 onwards, the Goldman Sachses of the world have never said to you, get out of the market, it's overpriced. Never. So they went through the crash of 29, they went through the crash of the Nifty 50 in 72, the crash of 2000 in the tech bubble. They never, ever say it because it's bad business. If you fight a bubble, you lose a lot of business. And because the uncertainty of the timing is so great, the client's patience is shorter than the uncertainty of the market. So sooner or later, you will be advising people to be careful. The market will keep going and going and going like it did in Japan.
You're saying that the people that manage money on a global scale, they have no incentive to tell you that the market's about to collapse, because if they did, their clients would withdraw their money and they wouldn't get their fees for managing that money. So what they do is they keep telling you things are going to be fine and optimistic,
yes.
But you have to kind of see through that yourself because they have an incentive structure which isn't aligned with yours necessarily. It may also be the case that those very people who understand these economic bubbles and cycles, they themselves are adopting a different strategy with their own money, but that at the same time, they're probably going to be telling you that everything's going to be great for a long time.
If you'll allow me to tell a story on this very topic. In the 98, 99, the tech bubble, so-called, the run-up to the top, I got into a lot of debates with the bulls. I would say it's horribly overpriced. And
the bulls. What's a bull?
Bull is someone who is extremely optimistic about the stock market.
Okay.
And a bear, someone who is pessimistic or careful about the market. There were 1,200 people in the audience, and it was the annual bash of the Society of Analysts. And I asked, before my turn at the debate, please put your hands up if you consider yourself a full-time stock market expert. 400 hands went up. I had people counting. And I said, I've got two questions for you. One, if the market, which is currently 31 times earnings, was to go back to a more normal 17 times, would it guarantee a major bear market if it happened anytime in the next 10 years?
A major down market?
Yes, if it went from what was then 31 times earnings. Every dollar of earnings sold for 31 times in the market. And the more normal average was closer to 15, 16, 17. And I used 17. If it went down to 17 anytime in the next 10 years, would it guarantee a major bear market? All 400 of them said, yes, it would. If it happened, it would guarantee a major bear market. And then the second question, of course, was, and do you think it will happen? And less than 1% thought it would not happen. 99% plus thought the market would go down, therefore guaranteeing a major bear market. And this was the engine room of all the Goldman Sachs and the Morgan Stanleys and the JP Morgans, all the great investment firms giving advice in America. The engine room who worked for them, the guys doing the analysis, doing the work, all believed in data that guaranteed a major bear market, which happened. But the people who employed them or represented them from a marketing point of view were on the podium with me saying, oh, Jeremy, don't get excited. We'll muddle through quite nicely. It was a huge betrayal of trust, if you wanted to put it that way.
And do you think that's happening now?
Of course. Who are the people representing the great investment firms telling you to watch out? If you look at the data, you will see over time, it's a series of great waves in evaluation.
Like this?
Like this. And we're not just in one, but in terms of the US stock market, we're in the biggest one, arguably, that has ever occurred. The noise to be careful and watch out and get out of the market is not deafening. In fact, you will hear nothing. You never have. You never will. It is simply lousy business for a big firm. I sympathize with them. I sympathize with them because when we did it in 98, 99, we were 2.25 years early, and we lost half our book of business in 2.25 years.
Because you were honest with the people about what was coming.
Well, through their eyes, we were wrong. We said, watch out, the market is overpriced, it will end badly. It went up. Therefore, we were wrong. Therefore, shoot us. People think you get shot for underperforming in a bear market, and that is not really the case. In a bear market, everyone freezes. Rigor mortis. They wait until the market has bottomed out, then they sit around and start to fire one or two people for having done worse than the others. But in a bull market, they're playing golf with their fellow pension fund officer. And he is making a ton of money, and they are not. They get very excited in a bull market, and they fire you instantly.
There should be a button just down below here. And if it says subscribed, you're already subscribed. If it says subscriber, that means you're not yet. And if you're not subscribed, please could you do us a favor and hit that button. It helps the show more than you know. And according to the algorithm, you're someone that watches our show, but you haven't yet hit that button. Thank you so much. What about for founders? I actually had a founder call me the other day, and he is running a relatively early stage tech startup. This tech startup has raised a lot of money. It's an AI tech startup. It's raised, I'm going to say, about $300 million. It's not profitable yet, but it's raised a lot of money. So it's living off investor capital right now. He said to me, Stephen, I think there's a collapse coming. So I'm going to go raise as much money as I possibly can right now, because I think when this collapse comes, businesses like mine are going to be unable to raise capital. And therefore, I will go out and I'll kind of like a bit of a vulture. I'll go out and pick up and buy up all these people.
Good lad. Good advice.
Good advice.
I think.
So for founders listening now that are somewhat dependent on investment capital, but even those that are just breaking even, what advice would you give entrepreneurs in this moment?
If you can lock up money, I would. If you can build a bit of conservatism in other ways, do it. Just brace yourself for impending problems, which is a pretty good principle anytime, but is a better principle than normal today.
So for founders, entrepreneurs who are, the sun is shining right now, but it's time to start acting as if a storm is coming.
Yes.
And the time horizon on that is hard to forecast. It could be weeks, months, years.
The stock market hinges on career risk. And Keynes was the great champ. He's a famous economist of the 1930s and 40s. And he wrote a famous book called The General Theory. Unlike the idea that the market's efficient, he knew it wasn't. He knew it was a behavioral jungle and that it would be given to bubbles.
And when you say efficient, you mean logical and one plus one equals 2.
The efficient market idea is that every company, every stock, the underlying company represents a long stream of future earnings and dividends, and that the ones in the distant future are given less value, a process they call discounting it back to the present, and the sum of all of that stream of earnings into the future is the stock price. And that, of course, is complete nonsense.
What it is the stock price is psychology.
The stock price is what you think the other guy will pay. If the stock is going up, it tends to suck in buyers, and that's called momentum. It's moving up, it attracts buyers. And every now and then, when the economy is favorable and money is obtainable, you tend to get these bubbles. And they play on themselves. The bigger and better they are, the more people get sucked in.
What do you actually think about the technology at the heart of all of this, which is artificial intelligence? Do you think it's overblown? Or do you think it is going to have...
It's going to change everything. One of the spectacular things about it, though, is how there's no consensus. So I've seen many times where the super experts and the academics think one thing and the players on the ground think another. But this is a situation where the Nobel Prize winners at the top disagree violently. The experts at the corporate level disagree violently. The people in the company disagree violently. There is absolutely no agreement on whether AI is going to make us all so rich we can sit on the beach and never do another day's work, or it will wipe us out, accidentally or on purpose, because it's a much higher level intelligence one day. And when was there ever a case where a higher intelligence was benevolent in a sustainable way to a lower intelligence. The one example is mothers to babies.
Yeah, I heard one of my former guests say this to me.
Jeffrey Hinton,
yeah.
That's how I came across you. And
Oh, really? Yeah.
started to follow your podcast, is because that was such a brilliant podcast.
It was so fascinating to me, and I followed his work and thoughts thereafter, and I realized that he now cites this example of mothers and babies being the only example. I don't know, for me it still doesn't hold well, because at the end of the day, some mothers aren't that, and fathers aren't that nice to their babies sometimes. There is a maternal instinct, but are we building a maternal instinct into AI?
That's what we should do, Jeffrey Hinton would say, and others. The ones who are most concerned about the risks say our one hope, if we mean to keep going ferociously forward in terms of the science, our one hope would be to build in very carefully a benevolent attitude. It would not seem to be impossible, but you should make sure you can do that before you push ahead. We are just pushing ahead, and that is going to be extremely risky, isn't it?
Well, I don't see how it can't be.
I don't see how it can't be, unless you make it programmed completely to be benevolent. I wouldn't have thought that was impossible. It might take a lot of extra research. It might require a slowdown at the rate of progress.
Do you know what I find curious about that idea is we're now going to get into the realm of what does benevolent mean? And that feels like a risky business, because what's benevolent to you and your religious beliefs or where you come from might not be benevolent to someone else.
That's right. You have to get them to accept a form of benevolence, which means, like the old robot laws of Asimov, that they can never do anything that they could construe as hurtful to humans.
And the definition of the word benevolence is the core desire to do good for others. It is the disposition to be kind, charitable, and focused on promoting well-being of the people around you. It's interesting because one of the new AI models called Claude has clearly been told to be benevolent. And there's this sort of online backlash taking place at the moment, because even my Claude, when I speak to it sometimes late at night, it will say things to me like, "That's enough, Stephen, go to bed." And I'm like, what? And sometimes it gets the time wrong, because the time on my computer might be off or something, because I'm in a different time zone or something. And it'll be like 10 a.m. in the morning and it's telling me to go to bed, that's enough now. And it's actually getting quite judgmental, as in like it's imposing its idea of what is good or bad on me. So if I said to it the other day, "Hey, could you redo this for me and rewrite that?" And it went, I'm absolutely not going to rewrite that. I was like, "What do you mean?" It says, "Well, I'm not going to change the data on that. That wouldn't be good." It's my data. I've literally just made this data for this presentation I'm doing. It refused to change data for me.
And how fast that has changed from, say, even a year ago.
Honestly, 3 months ago it wasn't doing this.
I had one where they made a joke. I'd been going on about toxicity and sperm count reduction and so on. Mm-hmm. He started to misbehave, and I said, "Well, what's going on here? In the end, we discussed what's the difference between machines and between AI and humans. And finally he said, "And at least I'm not lying in bed at night worrying about my declining sperm count." Now that has to be a joke, doesn't it? Yeah. It's all that, or it's teasing. The point is, it's so sophisticated, so quickly. And of course, Jeffrey Hinton says they are thinking machines.
Last night, so again, I had a problem with Claude because it started to kind of be my mother, and it started to impose on me what it thinks is right and wrong. And so I said to it, "Okay, actually, forget that. This has changed, this has changed, this has changed. This is no longer true." And I wasn't telling the truth. I was just trying to get it to stop being so telling me what to do. And it goes, "I don't think you're telling the truth, because I don't know if this is true." Wow, we've gotten to this point where the unintended consequence of trying to give it morals means that now it's becoming judgmental, and it's kind of like restricting your ability to think how you want to in a way, because it's telling you what good thinking and bad thinking is. It's going to tell you what good actions and bad actions are. And actually what will happen is any model that does that will be a losing model, and I'll go to somewhere else. I'll go to Grok, or I'll go to ChatGPT, or I'll go to Gemini. And then that model will lose, so one would say that they'll have to remove those restrictions to be able to compete.
Well, if you were right, and I hope you're not, what you're saying is you can't build in benevolent behavior, which means that it will sooner or later perhaps by accident, do something that is cripplingly dangerous to humans. The old paperclip cliche. It'll make paperclips out of everything, every metal it finds, and destroy the planet in the process.
Explain that for people that have never heard the paperclip idea.
That these intelligences involved in machines are literal to a degree we might find difficult to get our brains around. And therefore, someone has said, I'd like you to make as many paperclips as you can.
To an AI, for example?
Yes, a sloppily open-ended, bad definition. But then the machine, which by then has the means to do it, starts to make paperclips, and it keeps on going, and it needs metal, and so it runs out of easily available metal. It starts to collect metal that is not easily available, rips it out of your high-rise building, whatever.
And really it's saying that the unintended consequences of a simple, good-meaning instruction can sometimes cause catastrophe that you didn't expect.
Yeah.
And this is the balance now when you're dealing with intelligence, is there's so much subjectivity to good, bad, wrong, right, and so many unintended consequences that, for me, you go, all you need is stretch time, and the probability of something bad happening is almost inevitable.
Yeah.
Over a longer time horizon, 20, 30, 40 years, of well-meaning people that couldn't spot the unintended consequences. I mean, social media is a good example.
I mean, I question basically the well-meaning bit. They're now trying to maximize their profits and their growth and their appeal over the competition. And that actually, maybe one should talk about that. The Mag 7 and associated AI companies, looking forward versus looking backwards.
So the Mag 7 is the 7 market leaders. I'll put up this pie chart.
Yeah, lovely.
Of the Mag 7. I've got another graph.
And there's perhaps another 15 or 20 rapidly rising substantial AI corporation.
So when you say Mag 7, you mean Alphabet, which owns Google, Nvidia, Tesla, Microsoft, Meta, Apple, Amazon.
Yeah, well, that will do nicely. And if you look backwards, what you find is that these 7 each dominated a nice piece of business. They had close to monopolies, and they had it on a global basis. Tesla had a jump start on the electric vehicles, Apple, of course, on the smartphone, Microsoft on the original great coup of how to run your software on a computer. And then you look forward.
Meta social networking, Google search.
Right. Google search.
Nvidia chips.
And then you look forward, and you could not imagine a more different world. They're all girding for battle in the same marketplace, AI. They're beating their chests and saying, my 200 billion capex this year, in a single year, is bigger than your 105. Everybody is pouring enormous cash flows, and they're now beginning to borrow on top of that into the AI battle. SpaceX, 90% of its theoretical value is AI, even though their particular AI model is, it would seem, having its bottom kicked by 2 or 3 of the others. But looking forward, it looks like 7 people in the ring, right? There'll only be one survivor, they think. Everything goes to the one who gets there first. What a difference this was to 7 well-behaved, separate monopolies. Could it possibly be more different? They made bundles of money on their monopolies. Now they have no monopoly. There are 7 potentially sharp-elbowed, ruthless players determined to fight out with each other until they win.
And who do you think will win?
I don't know. That would be good to know.
Because SpaceX seemed to be aiming more at the infrastructure of data centers now, data centers in space. Lots of people saying that the best way to run a data center, which is the hardware that powers AI, is going to be from space. And so maybe they're going to try and find their own lane within AI, and they're going to get away from trying to build a frontier model like a ChatGPT or a Gemini or a Claude. And I mean, let's see what happens. And maybe Apple will just say, fuck it, we're good at hardware, so we'll license the model off someone else. We won't try and build a frontier model or get involved in chips or data centers. We're just going to focus on the hardware. 1
or 2 of them, and perhaps it's a pretty smart strategy, will try and opt out of that struggle because it's going to be obviously brutal.
Much of the reason most people haven't posted content or built their personal brand is because It's hard and it's time consuming, and we're all very, very busy. And if you've never posted something before, there's so many factors in your psychology that stop you wanting to post. What people will think of you. Am I doing this right? Is the thing I'm saying absolutely stupid? All of these result in paralysis, which means you don't post and your feed goes bare. I'm an investor in a company called Stan Store, which you've probably heard me talk about. And what they've been building is this new tool called Stanley that uses AI, looks at your feed, looks at your tone of voice, looks at your history, looks at your best performing posts, and tells you what you should post, makes those posts for you. You can also just use it for inspiration. And sometimes what we need when we're thinking about doing a post for our social media channels is inspiration. Building an audience has fundamentally changed my life, and I think it could change yours too. So I'm inviting you to give this new tool a shot and let me know what you think. All you have to do is search coach.stan.store now to get started. For every founder, there comes a point in building a company where your job shifts. From being the person inside your business, actioning everything, to the person responsible for absolutely everything. The only way I've been able to make this shift across the different companies and teams I'm responsible for is by knowing that the right systems are in place to manage everything. Systems that don't need me in order for them to work. Our sponsor Pipedrive is one of those systems, an easy to use, intelligent CRM tool for growing sales teams. My teams use it and have for the last decade because it's genuinely the most effective way to run a sales operation. Through one dashboard, you get every deal visible and every stage of the sales process.
Some things aren't just carried. They're worn like a statement. Some things aren't just carried. They're worn like a statement.